Today we will have and we will understand time value of money, very important topic. So we will understanding present value, future value, discounting value. So what will be the table of contents? So the first we will understand what is time value of money. Then we will understand present value versus future value. Then we will have some practical examples. Then we will have example of calculation. Afterwards, we will have understanding discounting, techniques of discounting, and importance of time value of money and decision making. So there are certain options or techniques available which is very helpful for the purpose of understanding why this time value of money is very important. Okay, so moving forward, the first thing that you have to keep in mind is what is time value of money. So the concept that money available today is worth more than the same amount in the future due to its potential earning capacity. Okay, so it's like a key point, like a dollar today is worth more than a dollar tomorrow. That means whatever money or currency do you have, there is a value in the future. Likewise, if we go in past, Samsung in 1938, they were like fish making company and they were never into this electronic business. But what they have done? So they have done in 1950, after 1950, they went for the electronic stage. And then they thought there is a makeover, there is a chance of getting some new products. So they thought there is a time value of money. So once they are investing certain amount, there is a future, and eventually they grow. They take 50 to 60 years to grow, and after 2010 they beat Apple and the largest electronic company having almost largest segments. So the time value of money is a fundamental concept that expresses the idea that a sum of money is worth more than the sum in the future. So it is related to the opportunity cost. Okay, so if we are connecting or we are taking any project, we have to think what will be happening in the future. So the idea, this is because money has the potential to earn interest or invest returns over time. Okay, so as the time progresses, there is a money, and the time itself has a chance that there will be a change in market. So daily we have an option where we can see the amount that we have already invested or whatever amount we are going for the future. There is always a time value of money concept. So we have to think what will happen in future. Moving forward, why is the time value of money is important? So why we have to count present value, future value, why we have to think about why how the finance will be helpful. So if you sum up this thing, the concept of time value of money can help in guiding investment decisions. Very important. Either you are investing for money market, capital market, long term market, short term market, medium term market. Yeah, either you are going for a market risk, or you are adverse risk, or you are trying to invest for the longer time or a shorter time. So you have to select a project which will gives you a proper output at the time when you have selected. So like I've taken an example. Suppose a business can choose between a project A and project B. Okay, so there are identical except that a project promises 1 million cash payout in a year one, whereas project B offers small in a 1 million cash payout in year 5. So the payout are not equal. Okay, so like if you are buying a company, likewise there is a Samsung and Apple, and if you are buying that company, like if you are buying an Apple and you will get 1 million in 1 year, and if you are buying an Samsung and you will get 1 million in 5 years, so there is no equal contribution. So the 1 million payout received after 1 year has a higher present value than 1 million payout after 5 years. That is actually correct. Okay, if you talk about 1990, $1 is equal to Indian rupee. If you can see, so it was very low from the today's market. And if we count about future value, like $1 after 50 years, so it will be more than that. So how we have to find what decisions we have to take. So any finances or any corporates, what they are thinking about the future is they have to keep on asking what will be the present value. and what will be the future value. So first we have to think what is the present value of the project that you are taking, and afterwards we have to think that whatever option you have, there is a time value of money and future and present. So we have certain formulas under which we will easily find out what option we should select. So most of the time when we understand the time value of money, there will be a concept where you will easily get to understand money will be an important concept for the payout in the future. If you go move further, so how is the time value of money used in finance? So there is a question arises, how both are connected, how both are related to each other. So the time value of money is a central concept in discount and cash flow analysis. So whenever you are doing cash flow analysis, the time value of money is always been the key aspect or a key factor. So one of the most popular and influential method for valuing investment opportunities. So it is also an integral part of financial planning and risk management activities. So if you have a large portfolio or if you have a large amount of money and you want to grow your business, so there are might be chances you go for mergers, you go for acquisitions, you go for contract manufacturing, you go for turnkey projects, you go for partnership with the government, NGOs. So whether taking this decision helpful in the future, so for that you have to count your present value and you have to count your future value. So how you will gather your countable finance? So for this, what you will do is you will try to examine the options available for you. So what you will do, you will try to have the maximum benefit that you have. So when you are counting for a future, you always go for a time value of money. So if you able to acquire right decisions at the right time, your finance or your company will grow slowly. Eventually, you will get a either goal maximization, like it is profit maximization or wealth maximization. And if you are planning for 15 years, 20 years, like you are going for a vision, then also time value of money is very important. So it is like interlinked with the finance. So if you want to succeed, it is not just the product, it is not just a system, it is not just the operational, it is a decision that you are taking today, it will affect for the tomorrow. So you have to think twice before taking any decision, because if you have taken a wrong decision, there might be chances in the future you have to take some other options and it will eventually make you loss. So how we will calculate time value of money, how present value, future value, what are the formulas? So moving forward, the first is present value and the future value. So we have two options. So present value, the current worth of a future sum of money given a specific rate of return. So if we are assuming what will be the present value of a company. Likewise, if you want to buy a project and you want to see what is the present value of this project. So easily by applying formula, you will understand present value of money. Later on, we will have a detailed formula where you will understand what will be the present value method. Going further, what is future value? So the value of a current amount at a specified date in the future based on an assumed rate of return, or we can say rate of growth or interest. You must be knowing mutual funds. In mutual funds, what they are doing, so in mutual funds they try to have go for growth and interest, what will be happening in the future. So that way you will get to understand whatever amount or whatever investment you are investing for the future, there is always a value and that value will be different from one another. So in a present value and a future value, we will try to understand the growth and interest. So what present value helps you for, that you can have current worth of a sum of your money. So what will be the present value today, and the future you will have a decision making power after 5 years, 10 years, whatever specified date you have taken, and you are assuming hypothetically that this much of interest you will understand or you will have. So that particular interest, what will be your future, how both are interlocked, how both are connected. So that way you can take decision based on present value and you can take decision based on future value. So moving further, we'll take what is the formula. So to calculating present and future value. So future value formula is future value is equal to present value multiplied by in bracket 1 plus r raised to n, where r is your interest rate, n is number of periods. Same way, if you want to calculate present value, then the formula is future value divided by 1 plus r in bracket raised to n. Again, there is r is interest rate, n is number of periods. So this is a simple formula where you can understand that what is the future value and what will be the present value. So when we are summing or when we try to have a larger idea that how to calculate this value, so we are assuming what will happen, and when we talk about present value, we are also assuming what is the today's value and how this project will eventually grow for the future. So moving forward, we'll take the examples also. So I'm giving the present value example. So taking an example, so suppose you want to calculate present value. So there is one situation. You expect to receive $10,000 in 5 years, assuming an annual interest rate of 5%. So what is the present value of future amount? Suppose you are investing, you expect to have $10,000 in 5 years and you are assuming 5% interest rate. Exactly same thing happens in the mutual funds also. So normally in mutual funds they are providing 12% minimum base rate, and if you can see different types of funds like hybrid funds, growth funds, equity funds, debt funds, so we will find 12% is minimum and 28% is maximum. Okay, and today if you go for a mutual funds, so they offer 18 to 22%, which is actually higher than fixed deposit or recurring deposit. So that is how the market has formed. That is how the number of amount of money has been changed. So people are now investing more in mutual fund. Why? Because they are expecting more returns in this field. So instead of going for a fixed rate, what they are trying to invest in a particular instrument where there are higher number of chances of getting return. So there is a market risk also. If you see any advertisement, at the end of the advertisement there is a disclaimer. What they are saying, market risk are there. Okay, so whatever they are offering, there is a market risk. And if you have already invested in mutual fund, you will find there is ups and downs in the market. So currently these 2-3 days you will see a downgrade change trend in the market. So there is a downgrade. So whatever investment you have done in this particular mutual funds or any other industry, you will find the downgrade trend. Where if you have invested for a call option or a put option or a daily investment options, you will find the market rate has increased. So suppose we have to understand present value of this particular instrument. Suppose we want to take decision whether to invest or not. So first step, what we will do? So step, we will identify the variables. So if you can see the read the example again. You expect to receive $10,000 in 5 years, assuming an annual interest rate of 5%. So what will be the present value of future amount? Okay, so future value, FV value is $10,000. It is already, you can see here. So $10,000 is your future value. Same way, interest rate. So what you are assuming? The interest rate that you are assuming is 5%. And what is the number of period? Very important. So how many years you want to invest? So you are investing for 5 years. Okay, so 3 things you have to first find out. So already you found $10,000 will be your FV value. Interest rate is 5% and number of period is 5 years. So the formula is present value is equal to future value divided by 1 plus r raised to n. So once you apply the formula and you are putting the formula, so $10,000 divided by 1 plus 5%, or you can take decimal 0.05, 5 divided by 100, 0.05 raised to n, which is 5 years, 5. So your present value arrives $7,835.26. So your present value for this example is $7,835.26. So you got your present value. So what this present value means? How you will identify or how this present value will helpful? So if you can see the present value it will change in a way that uh, this means that receiving $10,000 in 5 years is equivalent to receiving $7,835.26 today, given a 5% annual rate, the difference between future value and present value. So whether to take decision or not, this is how we are expecting. So the present value for this particular option is in a way that you will get the maximum number or amount out of it. So when you are expecting whether your decision is correct or not, we have to think whether these options are correct or not. So that way we are planning that whatever amount you are investing, there is a return over this investment, and whatever investment or whatever investing value you are going, there is always a present value of that item. Okay, so it's a simple thing. So what is the present value of your investment? That is $7,835.26 after 5 years, because 5% is a negligible. Moving further, same way we have understood present value, we will understand the future value. So in a future value, what will happen? Your investments, when it is increasing, so we have to understanding the discounting also. Okay, so discounting very important, because when you invest for the future time, if it is discounting, then we have to think that this product or this decision will eventually either affect in a positive way or a negative way. The same way you will get to understand the techniques. So what are the discounting techniques? So easily if you can find, there is a simple discounting used as a fixed interest rate, compounding which explains multiple periods with reinvestment, and there are certain applications which is investment analysis, loan amortization, and business valuation. So when you think about time value of money, okay, so you always think about what is the expected rate of return, what is the amount of investment you are thinking to invest, and you always think about what is the actual amount you have today. And same way you will plan your amount of money that you have already invested as a future value. So same way you plan that whatever amount you are investing, there is always a discounting feature. So eventually you will get the maximum benefit out of this. So whenever you are investing, whenever you are thinking to invest, there is always something which is very helpful. So you keep on investing these options. Going further, what is the importance of time value of money in decision making? So there are three things which is very important at the time of finance. So what are the three things? So the three things which is very important is businesses and individuals use a time value of money for financial planning, comparing investment, and managing funds. So financial planning. So what are the financial plannings? So to invest, to acquire a company, to merge a company, to allocate a company, to make this product, to buy this product, when to launch this product, whether to go for takeovers, mergers, acquisition, amalgamations, whether to buy this particular item. This will require financial planning. And to make this product, what will be your operational investment, how the technology will help, the blended technology that you are using for your product eventually help in the future. Then you do comparing investments. So how you do comparing investment? So whatever amount, whatever investment you have, you try to compare your investments, and that way you try to find what will be the future amount of this particular item, and that way you will understand what is happening in the market. Apart from that, the third and very important thing is managing funds. Okay, so either to go for debt, either to go for the equity, either to go for the hybrid, either to go for retained earnings, or what to select: profit maximization, wealth maximization. If you are selecting profit maximization, so if you have a larger profit, either to reinvest or where to invest. These are the important decisions you will take with the help of time value of money. So whatever options you have to think: future value, present value, discounting value. So you try to predict for the future, continuing or considering the today's environment, and that is also very important. So that is how this time value of money is very important. And if we conclude this session in that way, understanding the time value of money is crucial for effective financial decision making and allowing for better investment strategies and financial planning. Okay, so if you have already gone through these methods, what will happening? So you will have eventually larger options or more options at the time of selecting this particular value. So at the end of this session or at the end of taking these options, you will easily find the better strategies for the future, and you will get to understand what has happened in past, what has happened in future, and what we are trying to go for the present. Okay, so there are ample of companies. If I'm talk about a cellular industry, Nokia, you must be knowing it was a 56% market share in after 1990, when they have Symbian technology they were using in the mobile phones. You must be knowing Google has introduced Android. Okay, at that time Apple was also there. So Android technology was used, and they offered the same technology on the free basis to Nokia. But they think it is not secured. So they have not adopted this decision. And due to that particular thing, they are on almost 1% today. So they have lost 55% market share today, just because they have not taken the right decision, because they were not knowing what will the future value, present value, and how this discounting factor will help. So eventually this financial planning was not in a favor of them. Why it was not in favor of them? Because they have not went for the future value. Because if you can see, if you compare the past in 1990 2000 area, or of a decade of technology, the 2010 to the rest of 14 years, you can see there is a drastic change in the market. The instrument that you are going, okay, you must be knowing, like people are going for the stock, bonds, and all other options. Now with the fingertip you can do anything. Like it was, everything was offline. Now you can see everything all going on online. So like to take certain decision, we have to always think for the future. So this time value of money will effectively, or you, if you are using correctly, you will have the better investment strategies, and you will have a better financial position in the future. So if you are not investing, or if you are not understanding time value of money for your company, it will eventually not help you to generate maximum benefit. Apart from this, financial planning, how you are planning for the future. So this is how this time value of money helps. This was just an example. There are ample of example available, and you will take the current live examples also. That if you can, if we can take Bajaj Finance. Okay, 30 years back there was no financing companies, but now you will see NBFCs and all are coming together. Why? Because there is a potential, market potential that they are earning, and NBFCs, like government and non-government agencies, are giving NBFCs more chance. So if you are including time value of money, you will always think for the future and how it is working. So this was time value of money, where you are thinking what will happen in future. Moving ahead, the next and very important point is understanding money market versus capital market. Okay, so we have understood the time value, and we have understood how this thing will different from one another, and how we have to find whether your options are correct or not. So we have to understand money market, we have to understand the capital market. Both are different, okay, and both the functions are also different. So moving further, so first we have to understand introduction of financial markets. Very important aspect. In the realm of finance, understanding the distinction between money market and capital market is crucial. So like people are thinking money market and capital market both are same. Actually it is not. Both are different. Completely different, because their functions are different, their features are different, the users are different. Okay, so each market's unique purposing, catering different type of investment and financial instruments. And eventually we'll understand who are the investors and where they will invest. Okay, so both are blended thing and both are different. So first we will try to understand what is money market. Okay, so we have heard this topic somewhere, money market. So the money market is a segment of the financial market where short-term borrowing and lending occur. very short term market, and it is for less than 1 year, and like commercial papers, bills, call money market, this all are whatever instrument which is less than 1 year. So it primarily involved instrument with maturities 1 year or less. So what are the options? So such as treasury bills, certificate of deposits, commercial bills. Okay, so this market provides liquidity and safety for investment. So those investors who want to invest for only 1 year, like they are thinking there is a risk in investing this particular option, this particular topic. So they always think about, if they don't want to go for the risk, what they will do? They will always try to find whether this market is helpful or not. And this way they can take the correct decision whether to go for this segment or not. And if you are going for the money market, you have to make sure that whatever segment or instrument you are using, it is for only less than 1 year. Okay, so like you are studying right now, and after finishing your graduation or master, either you are running a business, or you are running your own company, or you are working somewhere. So if you want to invest, and if you want to invest for the shorter time, it is for the money market. So it is less than 1 year. You can invest for 7 days also. Okay, like if you are investing for a fixed deposit for 3 months, you invest for the instrument which is less than 1 year, like certificate of deposit, treasury bills, commercial papers. Is all the instrument. So why we are investing for money market? It is for the provision of liquidity and safety for investors. Okay, so you don't know what is happening in future. So you wait for your time. For the less than 1 year, you invest, and you have to think for how this value or these terms will go for further. So that is how the money market goes. Moving further, capital market, very important. So in contrast, it is a totally contrasting. If you talk about money market, where you go for only 1 year, in the capital market you can see the bull sign. So capital market deals with the long term investment, long term, which is a market of more than 1 year. Okay, so what it includes. So when you are investing in a market and the total net worth or the time, the tenure is more than 1 year, it falls under capital markets. So what it includes? So it includes buying and selling of stocks, bonds, derivatives, and with typically with the maturities exceeding 1 year. So this market is essential for companies seeking to raise fund for expansion and growth. So eventually, whatever investment you are doing, this market is for the larger period. Okay, so there is no in between. So you invest for the stocks, you invest for the bonds, you invest for the derivatives. Okay, future forward derivatives. Okay, so you are thinking for the future. So if you are investing more than 1 year, it comes under capital market. So why we have to understand both the markets? Because in today's situation, if you go 10 or 20 years back, people are investing for the money market instruments more. Why? Because they know these markets are very crucial. Apart from this market can have the biggest impact. Why there is a biggest impact? Because when you are investing or when you are going for the future, there is always, the future is unseen. So you don't know whether your investment will grow. And in a fixed deposit or recurring deposit, there is a minimum amount. Okay, so eventually if you invest in a correct term or a correct instrument, you will get maximum benefit out of it. So slowly, gradually, we have to think whether your markets are equally helpful, whether you have maximum options, whether you can invest your money in a way where you can generate the maximum benefit. So that is how you can differentiate both the markets. So in a money market, you invest for the less than 1 year. You know the tenure. So you have to be for the short term period. You don't want to go for the maximum time. You always go for a money market. But when you go for the capital market, you know there is an investment for the long term, and you are investing, you are understanding that this investment will eventually get a growth after a certain point of time, like 5 years, 10 years, 15 years. Okay, if you can see in the investment in shares, you must be knowing that this will happen. Okay, so nothing goes suddenly. Okay, so your decisions, your budget, fiscal policies, economic policy, every year budget, railway budget, normal budget, how they are interlinked with each other. This is how the your decision with the money market and capital market comes under. Moving further, how both are differentiate with each other. So if we want to understand both the markets and how what are the factors which affects, so what is the meaning and definition, what are the types of instruments are involved, what is the maturity period, how we will define the risk factor, how the return on investment will affect. So for that we have to understand the comparison between this both markets, money market and capital market. And before investing in this market, we have to think that what is my purpose of investing. Okay, if you have the right purpose and the right time, you will get the right options. Okay, so we have already understood the future value and present value. So when we think, so money market, so it is a market of it is a part of financial market where the lending and borrowing take place for short term up to 1 year. Okay, so so the time period is 7 days to 365 days, and even today 1 day instrument are also available. So if you sum up 1 to 365 days, if you are investing, it falls under money market. Moving further, so what is capital market? So it is a part of financial market where lending and borrowing take place for the medium and long term. So we have to compare medium and long term. So how we can differentiate? So medium term is for 1 to 3 years is a medium term, and long term more than 3 years is long term, or 3 to 10, 3 to 5, 3 to 15. This all falls under long term. Okay, so if you invest for medium term and long term, it falls under capital market. So this is the definition of the market. Then what is the types of instrument involved? So money market generally deal in promissory notes, bill of exchanges, commercial paper, treasury bills, called money market. Okay, which is extremely short term, will start from 1 day to 365 days. These are the instrument already available in the market. If you want to invest, this will be your investment timeline, and this is how you can generate the maximum profit out of it. Okay, so if you wish to invest for less than 1 year, these are the instrument available for you in the market. Then going further, capital market. So capital market deals in equity shares, debentures, bonds, preference shares, and derivatives. Okay, so these are the options. So you invest for the larger part, either in a medium term or long term. So if you are investing in shares, okay, so your share prices may fall, it goes again, so it keeps on ups and downs, but slowly gradually if they have taken the right decision, the company is working fine and company is getting profit, eventually you will get the good return out of it. And if you compare with the money market, your returns are always high, but there is a risk. Okay, so there is a moderate risk, there is a high risk, high return, low risk, low returns is a simple direct formula. Okay, same way you go for the bonds, you go for the debentures. Normally debentures available for 12%. Then you go for the preference shares also. Okay, so this is the types of instruments available in the capital market. Then what is the maturity period? There is a distinguish factor in the money market and capital market. So the maturity of financial instrument is generally up to 1 year. So if you are going for only 1 year, okay, so that is called money market. But if you are going for the longer period, which is more than 1 year, so there is no specific date like 3 years or 5 years. More than 1 year comes under capital market. So the maturity of capital market is longer, and they do not have a stipulated time frame. As I have already told you, there is no particular time frame, but you are investing more than 1 year, that everything comes under capital market. Okay, very important thing is risk factor. Okay, so when you are investing, like currently you are a student, okay, and you know there is always a risk factor, and there is always you are thinking whether your money will be in a right position or not, whether whatever decision you are taking, what will happen in future, there is always a question mark. And this question mark, how do you solve? Okay, so you think the instruments, you always think about whether your instrument is correct or not. So what you will do, you always go for maturity period. So how you are comparing for the maturity period? So and that way maturity period will eventually gives you the correct option of thinking of which risk factor or which market to invest. So there are certain factors or certain risk associated with the money market and capital market. So when we talk about money market, since the money market is liquid and the maturity is less than 1 year, the risk involved is low. So if you compare any of the instruments like bill of exchange, promissory notes, commercial bills, treasury bills, call money market, everything has a low risk value. Always keep in mind there is a low risk, which means if you are investing in a money market, you have lower risk. That means whatever return they are telling you or whatever return you are expecting, nearby return you will get in the money market. So loss in money market are always low. So risk is always low. But when we talk about capital market, if you can see here also there is a symbol, there is a dollar symbol, and you will see upward downward trend symbol. So in a capital market, due to less liquid nature and long maturity, the risk is comparatively high. As we all know, risk is comparatively high because you never know what will happen in future. Okay, if you go about 2019, nobody knows corona will come. Okay, nobody was a working country, like developing country like India, that like suddenly we have to stop making things and suddenly we have to think the bold decision and suddenly we are nowhere. And this is how your future exists, and this is why your risk factor arises, and risk contains with the return on investment. You always think whether your return on investment are correct or not. So what you try to do, you try to do what will be your return on investment. So the simple and the last thing, if you compare distinguish factor, okay, so the return in money markets are usually low. So it is a low risk low return simple market. If you know that 5% will be the minimum rate, so you will get 5.20, 5.36. Okay, you will not find the differentiate percentage in money market. That is also one of the differentiate factor. While in a capital market, the returns in capital market are high because of the higher duration. That means if you go for 3 years, you will get a higher return. If you go for 5 years, you will get a much higher return. If you go for 10 years, you will get the much more return. That means the longer you stay in the market, the longer the chances are to get the profit. So that is why people are thinking whether to invest here for this particular period or that particular period. So we are thinking, yes, we do have this instrument, but we have to think whatever amount, whatever investment we are doing, we are keeping in the mind what is the today's scenario. And thinking about today's scenario is always brings the future. And this is how we can plan your options. So what is the key differences in this money market and capital market? So the main features or the main things we have to consider is maturity periods, risk levels, and investment objectives. So maturity period, which is less than 1 year. Risk, if you are asserting, if you want to go for the higher risk, like if you are having age of 20 and you have certain amount, so you always have to go for the capital market. Don't think about investment for 10 years. You will eventually get a good return. But the same way you are investing your money in luxurious instruments, eventually your investment value will go down. So taking a higher risk in a lower age, eventually you will get more stronger financial options in the future. And if your investment objectives, like if you are having an amount and you have to think what is your objective, that way you have to select your particular option, either to go for money market instruments, generally safer and more liquid. So you go for the money market because it is safer and you will get the liquidity faster. But to get a higher potential, you are thinking for the potential returns, but having certain risk or a higher risk, you always think about the capital market. So whenever we are thinking whether we are investing for the right time or correct period or not, we have to always go for the key differences. Okay, so these are the four things we have to think, considering the period also. Then last thing comes under what is your investment strategy. So depending upon your mentality, depending upon your adaptability, you will, so investors typically adopt different strategies based on their goals. So you must be thinking about your goals. Okay, so likewise if you are investing for a mutual fund, if you want to buy a car and you're at the age of 20, if you think you want to buy a car at the age of 27, and your car will be, if you see, if the future value of your car will be 10 lakh, so eventually you have to invest 10,000 per month SIP, systematic investment plan. Eventually you don't need to go for the amount. If the car that you're thinking to buy is 10 lakh today, after 7 years the value of the car will increase. Eventually, if you are investing right now, your amount of output will also increase, so your return on investment will also affect, and that way at the age of 27 you will easily able to buy your investment plans. So money market investments are ideal for those seeking liquidity and safety. So if you want to play safe, if you want to think that your money is okay, and you just want your safer money, and you don't want any other things to get in, so it is a safer option, and your liquidity and safety, it comes under the money market. So you don't have to think about many more things. It is advisable to go for this option, and eventually you will get the maximum benefit out of it. Okay, so slowly, gradually, you will get to understand, whenever you are investing your liquidity and safety, you will go for money market. But question arise, why capital markets? So there are two things. One is growth, one is wealth maximization. Okay, wealth accumulation. So if you want to these things, you always go for a capital market. Okay, so there's always, don't put your all eggs in one basket. You always have a safer and riskier options also, and depending upon your option, you always think about the future, and that way you plan how this market distinguishes with each other. So if we want to conclude how these all are working, so understanding the distinction between money market and capital market, it is essential to inform investment decisions, and each market serves a specific purpose and catering different investment needs, influencing overall financial strategy and portfolio management. So this means that each market has a different option, different segments with the amount of investment you are doing, which means that when you are investing, or when you are investing for the larger time, you always know whatever investment you are doing is always on a correct base, and that way you will find which market to invest. And this is how we can plan both the things together. So this is how we have learned time value of money, money market versus capital market, how both are applying to each other, and when you are investor, you have to take the correct decision as and when required. I hope you understood the session. It's time to take the questions.